July, announced hopefully by the Chancellor in November.
And what sort of hoops do you have to jump through to get the mandate?
You've got to have partnerships with pension funds to help bridge that capacity gap. You've got to show that you've got deal flow. In our case, we invest with companies spun out from Britain's universities and laboratories, and you've got to show a team with a track record. It's putting of all of that together.
On the basis of what you've heard about this initiative, and we only know what's been reported really in the newspapers thus far. Do you think this is going to be a success? Do you think what's it going to achieve?
So the biggest risks, I think, on this are the capacity, which we talked about, impact. We don't want more money going into delivering fast food faster, which has been a lot of Britain's success so far in our unicorns, which we're good at. Yeah. And then the final bit is actually making sure that we're linking it to companies that work and spreading it out across the whole of the industry here in Britain. And that we think we can do, and other groups in our industry are there. You know, Britain's actually got a fine record in venture capital.
We do indeed, and we have a great record in startups. The big challenge is scaling up. Yes. Is this something that we're going to be able to address through this initiative?
I think so, but we've got to make sure it actually leads to real action. That's why ambition and aspiration by the biggest groups needs to be matched with things like the government's programme on lifts, where they're actually announcing something which is tangible with a clear date. So if the government can do that, then I think we're actually in a position where these companies who have got the potential, they've got something they can aim for, and with that, we and they will invest, and British companies will scale up faster.
What sort of sums do you think are likely to be decanted into these companies at the outset?
Well, in Britain, just around the universities, we think you could deploy at least £2 to £3 billion a year. Now, remember, when we're talking about 5% of insurance company and pension assets, that's 50 billion. So it's, that's 50 billion in total. So in the small sector that we're in, universities and ventures, there's a lot of money that go in straight away. But when they grow bigger, for example, tokamak energy, nuclear fusion, that will require billions as it grows. And unless you've got the insurance companies and the pensions, we'll be reliant on foreign capital and the sovereign funds who we've been talking to already, who are quite happy to back Britain, but they've been saying, where's the British money? So now it should come.
Let's hope so. Douglas, good to talk to you today. Thank you.
My pleasure.
Some other business news stories for you now. And Thames Water has today announced its shareholders will inject a further £750 million worth of equity into the business during the next 2 years. That was less than the £1 billion that the regulator Ofwat said last week the company was trying to raise. The cash injection comes on top of the £500 million that investors put into the company in March. Thames said a further £2.5 billion would need to be raised between 2025 and the end of the decade. Well, the news came as Thames reported an underlying pre-tax loss of £82.6 million for the year to the end of March. That was down from a loss of £935.6 million during the previous 12 months. Thames also revealed that its debt pile grew from £12.9 billion to £13.9 billion during the period. BT confirmed this morning that it has begun the search for its next chief executive. Confirming a story broken by Sky's Mark Kleiman at the weekend, BT said that the current CEO, Philip Jansen, had indicated he planned to step down at some point during the next year. He's been in the role since February 2019. But among those being tipped as his successor are Mark Alera, the head of BT's consumer arm, and Alison Kirkby, a non-executive director of BT, who's currently chief executive of the Scandinavian telecoms group Telia. EasyJet said today it was cancelling 1,700 flights during the current peak summer season owing to air traffic control disruption in Europe. The carrier said the cancelled flights represented 2% of its flying programme for July, August and September, and said the majority of the cancellations affected flights from its main base at Gatwick Airport. Some 180,000 customers have been affected by the cancellations, but EasyJet said 95% of them had already been rebooked on an alternative flight. Now, as it's Monday, we wanted to bring you some good news. Your cup of coffee should soon be getting cheaper. The cost of wholesale Arabica beans has fallen dramatically in recent months after reaching the highest level in a decade. One of the biggest names in the industry, Lavazza, is focused on one of its biggest sponsorship events right now at Wimbledon. All of this made it a good time to catch up with the company's chairman, Giuseppe Lavazza.
First of all, as a company, we share the same values of this beautiful sport. It's a passion for excellence and the challenge and strive victory I think, and also the chance of discover new young talent that, of course, offer a lot of new emotion to the crowd when they start their career. As, for example, a young player as Alcaraz of Yannick Sinner, that not by chance is one of the Lavazza ambassador. At the same time, it's a very good opportunity to showcase the capability of Lavazza to set up a big operation in coffee and offers about 100,000 of beautiful coffee cups and coffee recipes to all the people that are attending the matches.
Now, it's obviously a very difficult trading environment for consumer-facing businesses right now. How are you navigating the inflationary environment?
It's a very tough period of time. We decided to try to absorb many of the costs inside our margin to keep the price as lower as possible and to pass to the consumer a small percentage of the big increase in the cost we had over the last 2 years, not only 2021, but even 2022. And this was a very rewarding strategy for Lavazza because we have significant growth in volumes in all our geographies, of course, a reduction in our margin. But we can support that because we are not listed. So as a family company, we can really take for the long run.
I think the price of green coffee beans is up by more than 80% over the last 12 months. I mean, that seems to me to be a rise of such a magnitude, even you can't absorb all of that and you have to pass some of that on. Or is that the case?
Yeah, of course, we had to pass some to the consumer. It was impossible to absorb everything. But just to give you the magnitude of the increase of cost we had over the 2021 and 2022, we're talking about 550 million euros in a company with an EBITDA of about 300 million euros, so nearly 2 times our EBITDA. So, of course, it was a monster maneuver to try to cope with. And part, of course, was a price increase, but very carefully managed. The other was, of course, margin erosion. And the third, monitoring of operational costs. That's an important part of our action inside the company.
In terms of your sales, you grew sales last year by just over 17%. Out of home was the fastest growing channel for you. Has that been the case this year?
Yes, because by good chance, away from home is recovering quite well, the volumes that they had before 2019. So this is a very good news. In 2022, for example, in UK, we experienced a growth 34% in away from home. So very, very strong.
To what extent is the fact that the Eurozone is currently in a technical recession having an impact on your sales within the Eurozone? Or is coffee something that people feel that they have to buy regardless of the broader economic backdrop?
Coffee is part of the global economy. So when consumption go down, even consumption in coffee can go down. That's exactly what happened, for example, in UK in 2022. Where coffee consumption went down 6.5%. And the opposite, our company was able to grow 6.7%. So this just gives you the idea that if you manage very carefully your prices, you accept a reduction maybe in your margin, you can survive even in an environment with such a strong inflation. But of course, we are very concerned about the future of the economy. And the case of a recession is something they are looking for with a lot of, we pay a lot of attention to that.
Now, Britain's canal network is at risk of closures. That's the warning today from the Canal and River Trust, the charity that runs the 2,000-mile-long network of canals in England and Wales. It came after Therese Coffey, the Environment Secretary, announced that the Trust will receive a funding package of £400 million between 2027 and 2037, on top of the £190 million it's due to receive between now and 2027. But she also said the Trust would increasingly have to move towards alternative sources of funding. Well, joining me now is Richard Parry. He's Chief Executive of the Canals and Rivers Trust. Richard, welcome to you. I mean, this isn't a surprise. I mean, when your trust was set up 11 years ago, the government said then that you were going to have to rely on alternative forms of funding.
Yes, and we've been very successful in growing those alternative sources of funding. But fundamentally, the canal network needs investment. And whilst we have ambitious plans to grow other sources of income, it really depends on a long-term partnership with government government that provides the investment that's so vital to all the benefits that it delivers. Economic benefits, 80,000 jobs we estimate depend upon the canal network, all the health and wellbeing benefits, nature and biodiversity, and the business case for government to give the investment that is needed is overwhelming. And the settlement announced today would almost certainly lead to the inevitable decline of the canal network over the next decade or so.
How far short of your requirements is the package offered by the government today?
Well, we're currently in a position where our grant is not being inflated, and that, of course, is causing us quite a lot of difficulty with the current rates of inflation. And what government is proposing is not only to freeze us for the next 5 years, but then to reduce grant in nominal terms, so no allowance for inflation. We need a settlement that enables us to grow the income that comes from government, whilst we also grow income from other sources. We recognise that the long-term future has to be to grow donations, to grow support from businesses, from members of the public, to do what we can to ensure we develop a stronger connection with all the communities around us. But fundamentally, it needs that level of government investment to safeguard the benefits that are so vital. And of course, to mitigate the risks, because our canal infrastructure, 250 years old, runs through communities, carries water across, from one side of the town to another. And if we don't care for that infrastructure, it could potentially pose a threat to communities, as well as losing the benefits that so many people depend upon.
Richard, having read your most recent annual report, you've got something like £232 million worth of industrial property, another £144 million worth of office property. You're not quite in the poorhouse yet. You could probably sell some of those assets, couldn't you?
Well, that would be to take the very short-term approach. The endowment that was given to the trust when we were created was all about the long term. Indeed, we've had a very strict agreement with government to not use any of that long-term endowment to fund the day-to-day operation of the waterways. If we were to do that, we'd effectively be taking the income from the future to plug the hole today, and almost certainly lead to an even faster decline in the canals. So we've had to be very strict about ensuring that endowment is grown for the long term, whilst we secure the income that keeps the canals open and safe and available for the millions of people who enjoy them every day.
All right, Richard, we have to leave it there, I'm afraid. Good to talk to you this afternoon. Thank you.
Thank you.
Still to come here on Business Live, we'll have a look at how the markets have closed this Monday afternoon. Stay with me.
Well, they've risen to 17,000, which is an all-time high, and we expect them to keep increasing, so about 26,000 by 2040. And what's behind it is actually really interesting because it relates to social trends. Skin cancer takes a long time to develop, so what we're seeing is actually the effect of UV exposure potentially many decades ago. In the 60s, as you said, there was an increase in package holidays, much lower awareness that UV rays could cause skin cancer and much lower sunscreen usage. So these are all factors, and we have an ageing population, so there's a bulge in the over 55s, which is also contributing to the increase in actual numbers. Definitely what we saw since the 60s is that there was a trend towards being tanned being a positive thing. And so, but also sunscreen usage was much lower then, as you said. So over the years, I think that's changed. Our recommendation very much is for SPF 15 at the very least, and that's when it's applied regularly according to the instructions and generously. Some people recommend SPF 30 as well to take into account the fact that a lot of people don't apply sunscreen as generously and regularly as they should. But there have been really great advances in treatment for skin cancer. So now most skin cancers are just excised, so you don't require chemotherapy or immunotherapy, and often an outpatient appointment as well. We think about 9 in 10 skin cancers are preventable, so they're related to UV exposure. So hopefully, over the very long term, as sunscreen usage has become more prevalent, we would like to see that curve changing. But for now, I think people can be reassured that if they spot any changes in their skin, do go to their GP. And actually, if it does turn out to be skin cancer, it will be very treatable.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Well, European equity markets have had a largely positive start to the week following some weak inflation data out of China overnight. Talking points this afternoon include the German chemicals company Evonik, which is off some 1% in Frankfurt after cutting its full-year earnings out. There are all the main European indices in positive territory. Here in London, the FTSE 100 is also in positive territory right now. It's finished off just under 1/4% higher. Energy and consumer stocks lifting the index. The leading gainer in percentage terms is Flutter Entertainment. That looks like a bit of bargain hunting there after it hit a 6-month low on Friday. Among the leading fallers is the property group Land Securities. It's off by just under 1% this afternoon on broker comment. Outside the FTSE 100, the online trading platform Plus 500 is ahead 2% on a trading update, while the publisher Future is up 7% after announcing a share buyback plan worth up to £45 million. The legal services provider Knights Group is also ahead by 6.5% or so on a trading update. Meanwhile, the legal and business services group DWF, its shares up some 32% on news of a takeover approach from the private equity firm Inflexion, valuing it at £342 million. Well, on Wall Street, stocks have made a subdued start to a busy week in which inflation data on Wednesday is the key release. You can see it on the screen there. JP Morgan Chase, both it and Citi are up ahead of second quarter earnings on Friday. On the foreign exchange markets, the main talking point is the US dollar, which has fallen to a 3-week low against the Japanese yen. Sterling more or less unchanged right now against the greenback. The pound is off 1/4% against the euro. The single currency, meanwhile, up 1/5% also against the dollar. The oil price, meanwhile, last week enjoyed its best weekly performance since April. It spent most of the day in negative territory, but look at that, it's just popped into positive territory. It's more or less unchanged, actually, looking at that. Barrel of Brent crude right now will set you back $78.49 a barrel. Well, joining me now is Tom Stevenson, Investment Director in Personal Investing at Fidelity. Tom, good to see you this afternoon.
Hi.
Before we talk about earnings season, which is crucial, what about those numbers out of China this morning?
Yes, I mean, it's a completely different story, isn't it, from here in the West, where we're so concerned about inflation. They had the opposite problem. CPI actually fell. Producer prices, the factory gate prices actually falling at their biggest rates for 7 years now. So I think what we've seen in the markets today, we've seen a more positive tone to markets than we've had in the last few days, is actually a reflection of that, because I think there's some optimism now that the Chinese authorities are going to have to start stimulating the economy in a way that they appear to have been resistant to do so far in this post-COVID period that we've been through.
So China potentially exporting a bit of lower inflation.
Yeah, absolutely. And I think that we'll see that later in the week. And we've got the US inflation figures on Wednesday. Headline expected to come in at just over 3%, which would be the lowest for a couple of years. And so, yeah, I think that, we've turned the corner on the inflation front almost everywhere except possibly in the UK, of course.
Yes, well, Andrew Bailey is, we've seen some comments from him already. He's speaking at Mansion House tonight. He said he does expect inflation to fall pretty substantially in coming months. We've heard that before, though, haven't we?
Well, I mean, the track record of predicting movements in inflation is not good. I mean, I seem to spend my life going on programmes like this and explaining why inflation is worse than we all expected it to be. But I think it will start coming down. But, the price that we're going to pay for that is much higher interest rates, probably for longer than we expected.
Yeah, and a weaker housing market too.
Absolutely.
Yeah. Now, earnings season kicks off on Friday. JP Morgan and Citi kicking things off. What are you expecting to see?
Yeah, so as usual, the banks will start things off on Friday. I think this earnings season is really very important. They're all important, but I think we're seeing a bit of a disconnect between what's happening in the bond market in terms of rising yields, rising interest rates. You would have expected the stock market to have not performed as well as it has this year. So the stock market is looking forward to better earnings next year, and I think that this earnings season, second quarter earnings season, is going to be a bit of a down payment on that. We're going to see whether a bounce back next year is likely. The expectation is for a 9% fall in earnings year on year. But if you go back 3 months ago, that's what we expected 3 months ago with the first quarter earnings season. It actually turned out at -3%, so better. So if we get that kind of outcome this time, I think that would be a positive for the markets.
And I guess the banks are not really the best harbinger in that respect, because they're all going to be doing very well because of the expansion in net interest margins.
Well, I think there's a two-way pull with the banks. The expansion of the net interest margin is a positive. It improves profitability for the banks. The counterpoint to that, of course, though, is that I think we're going to see an increase in provisions against bad loans. I think, quite a significant increase in provisions, probably the biggest increase since the early days of the pandemic.
All right, Tom, lots more I wanted to ask you, but we're out of time, I'm afraid. Good to see you this afternoon. Thank you. Well, that's it from me. I'm back again tomorrow morning at 11:30 with the latest edition of Business Live. We'll have a bit of reaction to that Mansion House speech as well, I've no doubt. Thanks for joining me today. Cheerio.